This meeting is being recorded.
Hey, good evening, everyone, and welcome to our 6 p.m. session where we're going to be covering student loans here. We have a guest speaker, Kyle Gallagher. He is with GradFin, and he's going to be taking us through this presentation for us. So really glad to have him with us, an expert in the field, and I will pass it over to Kyle to take over.
Great. And, Ryan, can you hear me? And just make sure everybody, cool. Hopefully I'm coming in. Hi everybody. My name is Kyle Gallagher. I'm gonna go through student loans today. I'm gonna tell you a little bit about GradFin, which is my company. Try not to stick on that too much, but really give you a good understanding of the student loans that you may have or you may be looking to borrow, as well as the different repayment options on those loans and some more dynamic options that aren't talked about as much, but are extremely valuable. So Ryan, let's just get to the first page here is just GradFin's mission statement. So my eye controller. Can you hear me now?
Hey, Kyle, is that you? We can hear you.
You can hear me now?
Yep, I can hear you.
All right, and still?
Yep, you're still good.
All right. Well, sorry, I think I confused everybody by dialing in on the my computer mic is broken. So, but great. Well, thank you everybody for joining. Looks like we have a good crowd here. What I'm going to do is take you through a little bit of what GradFin does. Just a quick introduction. GradFin is my company, one of the founders. But then we'll go through student loans, different types of student loans, when you would be interacting with them, how the interest rates determined and priced. And then we'll cover different repayment options on these loans. But let's just kick things off. I think it's a great way to get started. And one more page here, Ryan. Cool. Great. So our mission statement, GradFin, we're going to try to navigate your perfect repayment plan, but also just give you a good understanding of what's going on, because lots of weird things going on with government assistance and what's happening with your loans. There's a big deadline coming up here in May, and that can really affect your affordability if you're not planning for it to come back on, if it does. So we'll discuss that, but just quick background on GradFin or mission statement. Our focus is to help people with their student loans so they can start saving for their future. And so that's helping people to minimize their cost, minimize their payment, get into the right repayment plan so that you're not stuck with these things for your whole life and you can really start preparing for your future. So we're always not just focused on refinancing people or not just focused on getting in a government plan. We want to figure out the best solution for you and present you with those ideas. Let's move forward here. There we go. Why GradFin? We can go to the next page. Some of the things we offer is one-on-one consultations, and you can sign up through our webpage, www.gradfin.com. And you can go through and navigate to a free student loan consultation. In that consultation, you would connect and upload your loan information. We would gather some credit information about you, just a soft credit pull, so kind of the same thing as like Credit Karma. But that would allow us to explore all the different options that are available to you, and whether the different types of loans you might have. We might explore refinancing if that's appropriate, depending on your work, life situation. And we also might explore government programs, and we highlight the Public Service Loan Forgiveness Program here. But we also help people navigate through other income-driven repayment programs to maintain affordability with your loans until you can start paying them. Again, our idea is the long-term value for the customer, so that you can really prepare for your future. So let's get done with the quick intro for GradFin. Let's get into what's going on with student loans. This is where we can talk for ages. So don't let me do that. I'm going to keep my eyes on the chat. If anybody has any questions during the presentation, feel free to shoot a chat up there. And if I see it, I will address it and as we work through. But student loans, it's about $1.7 trillion of student loans that are outstanding. Despite a lot of messaging, I saw like that the CARES Act and having 0% has saved borrowers a ton of money. It hasn't saved anybody any money. It's really just kind of kicked the can down the road for people. And we started with $1.7 trillion. We're going to finish with probably a little bit more of student loans by the time we finish the CARES Act, because you had a whole nother year of allocations come for the people who graduated. But it's about 70% of undergrads will have student loan debt. The average balance of student loans for somebody coming out of undergrad is about $35,000. The federal student loans for undergrad will have like a 4.5% interest rate, but if you've got private student loans, that average interest rate creeps up to like 6-7%, which can be pretty darn pricey. You see the numbers. The medical community is definitely afflicted with the student loan debt. Nursing, just an undergrad degree, can be $56,000. PA is $82,000. But this key thing that we've noticed is people are completely uneducated on their loans, and ever since we started our company, we're now doing 700 interactions with clients a week. But it's approximately 90% of the people we connect with don't even know the interest rates on all their loans when we connect. And so people kind of throw money at these things, hope they go away, but they never really dig in to see how they're working. And that's what we really try to engage with our clients, make sure they understand the conversation, make sure they understand what's going on, so they know how to fight the battle. But let's move forward here. And we can skip through this. Cool. So where are student loans today? And federal student loans essentially are the bulk of the student loans that are outstanding. If you borrow for 4 years of an undergraduate education, you're capped out at about $27,500 of direct federal student loans. And then if you go to graduate school, the loans can exceed, can go up to $100,000 a year. So they can really get lofty in graduate school. In graduate school, you're going to borrow through direct graduate student loans and then graduate plus student loans. And the interest rates on those plus student loans can sometimes be 7 or 8%. The direct graduate student loans are a little bit more affordable, but that's where federal student loans are. But because of the CARES Act and because of COVID, on March 13th in 2020, that time it was President Trump, and kicked off. He gave a speech on that Friday, and he listed all these different things that were going to come to the American people as we were heading into the shutdown, and one was student loan benefits. And essentially what it did for most borrowers is it just set all federally owned student loans at a 0% interest, and there's no required monthly payment for them. And so initially that was just supposed to carry through till September of 2020. But it's been extended going on 24 months in March. And now it's going to go through, as of today, May 1st of 2022. So a lot of borrowers, good question, Jeannie. I'm not 100% sure, but I'll address that a little bit later. She's asking about public service loan forgiveness, which is a pretty cool program. And we'll go into a little bit more detail, but she's specifically asking about health education assistance loans. Some of those are convertible into direct federal student loans. I know I've tried to execute consolidation on one that was unsuccessful, but I think it depends on the issuance. A lot of those are considered Perkins loans. They function very similarly, and those can be converted. I'll have to get back to you though, and we'd really have to take a look at when they were issued and who issued them to see if your loans specifically can be converted. It can get down to some pretty specific details, and we'll also address the waiver in a second too. All right, so during the CARES Act, no required payments. So all these people, nobody's been making payments, but the loans might kick into gear here in May. And so if you have federal student loans, you really need to make sure that you're properly set up for a repayment plan as we emerge from the CARES Act. If you don't, and you're not properly set up, typically what would happen is you would default to the 10-year standard repayment on your loans. And let's say you've been using income-driven repayment. They've been very liberal in how they've been doing that, but there is a chance that you can fall off the income-driven repayment program, and you could have a really high monthly payment coming off of this if you don't make sure that you're still on that program. So that's a very important thing to do. Now, Ginny here is specifically asking about public service loan forgiveness. In the CARES Act, one of the most interesting things that I think, and surprising things that I thought came out of it was every month that goes by, as long as you're working full-time for a qualified employer, you don't have to make any payments on your qualified repayment program, and you'll still achieve qualifying payments each month. This is huge. We have a program where we advise for public service loan forgiveness. We have over 4,000 members, and every month that goes by is essentially a point. And if they earn 120 points, they can get their loans fully forgiven with no tax ramifications. And so this has been a huge benefit to a lot of those participants. And we were really surprised that the government put in that caveat, but it was great, and it's addressed a lot of problems and saved a lot of money for our clients. We can go to the next page here, Brad. So talk about types of student loans, and next one here. Essentially, there are private student loans, which are loans that are issued by a private vendor like Discover, Sallie Mae, Wells Fargo. There's hundreds of them. And then there's federal student loans. And federal student loans are issued by the federal government. Now, there's a bunch of different types of federal student loans that you can access at different points of your education. And for people who are in undergrad, there's the direct federal student loans that are issued each year, and they're capped out. They start at about $5,500 your freshman year, and then each year you can get progressively a little bit more. And I told you on a 4-year education, the max you can do is about $27,500. Now, if you're fully funding your education with loans, there's not a lot of schools that you can go to for 4 years for $27,500. So you're going to need additional loans to get yourself through. And so this is where people will tap into or use either Parent Plus student loans, which are federally issued, or they'll use private student loans. Those private student loans, again, your Sallie Mae's, Wells Fargo, Discovers, etc. And the Parent Plus student loans are different from the direct undergrad because they're going to be issued not to you, the student, not in your name, but they're going to be issued directly to your parent. They're in your parent's name. The convenient part to this is the Parent Plus student loans provide great access to capital. So even if your parents have some credit troubles or have had some financial issues, and maybe they're not quite as qualified for the private student loans, typically they will be allocated Parent Plus student loans. That's a blessing and a curse because it can also lead to overborrowing. So you really have to be fiscally responsible when accessing the Parent Plus student loans. Additionally, the cost of the Parent Plus student loans is much higher than your unsubsidized and subsidized direct student loans. The Parent Plus student loan has an origination fee, which is usually 4.25% or bigger. And that means just if you're borrowing $10,000, the loan's going to start at $10,425, right? It's a 1% origination fee. So there's that 10%. So 42.50. So that's expensive because then what happens is you've got a higher interest rate that then accrues off of that. Parent Plus student loans range from, I guess they were 5.75% or so a year or so ago, but typically they're in the 6-7% range. So that can get pretty expensive. So people tend to price Parent Plus student loans against the private student loans. Private student loans can range in interest rates from really 4%, and I've seen them as high as 14%. Now, these loans are issued directly to the student and in the student's name, but you're going to need a cosigner. So a parent or grandparent's going to have to cosign. Now, most 17, 18, 19, 20-year-old kids don't have a ton of credit. So they don't really look at the borrower so much as they look at the school that the person's going to. They look at the maybe the major, and then they're going to look at really the parent or that cosigner's credit to determine that interest rate on the loan. And so, if you're trying to be thrifty, the Parent Plus student loans versus the private student loans, that's what you're comparing. Another advantage to Parent Plus student loans, you get access to all of the federal repayment programs, or most of the federal repayment programs. There's income-driven repayment programs you can use. Depending on the balance of the loans, you can extend them out for 25 or even 30 years sometimes. The private student loans, the day you sign that contract, you're going to be on a set repayment program or set repayment term. So whether it's 5, 7, 10, 15 years, it's going to kick into repayment 6 months after graduation. So that's undergrad. For graduate school, a borrower, if you're going to graduate school, you can borrow up to $20,500 of direct federal student loans each year. So each year you matriculate, you can access that $27,000 or $20,500, and those are usually a no-brainer. They're pretty cheap, and you want to take them because they have great repayment options and usually a pretty low interest rate. Now, if you have to borrow more than that $2,500, then or $20,500, then you're going to have to access the Graduate Plus student loans. These are priced the same as the Parent Plus student loans. So now this is where you might shop private student loans versus Graduate Plus, but really it's going to be determined by where are you heading? Because if you're going public service loan forgiveness or to a public service loan forgiveness eligible employer, no brainer, you take all federal student loans. You don't think twice about it. Even if you can go to, if it might be that you're going to work in the nonprofit setting or for the government, it's a no-brainer. You take all federal student loans. But let's say you're getting your MBA and you know you're going right to Wall Street or something like that. You know you're going right into a private sector employment. That's when you're going to shop Graduate Plus versus private student loans. Let's go to the next one here. Now, how are the interest rates determined for student loans? And we get these calls all the time from really December all the way through May. People asking us where federal student loans are going to be priced the next year. And the fact of the matter is nobody knows because they move. And it only moves, the pricing is set to the US Treasury market. US Treasury market moves every day. Now the pricing is set, I believe it's like the Wednesday after the 15th of May, but don't hold me to that. I'm not positive it's that date, but I know it's within a week of that date. And on that date, at the close of the Treasury, they basically look at where the auction for the 10-year bond was, and they set the prices for all the student loans next year. If you want to get really into details, you can look up on studentaid.gov and see what the difference is. So it's the same difference each year. They basically add a 1.5% or 2.5% onto whatever the Treasury was that day, and that's going to be the pricing for each of these loan sets. Now your undergraduate direct unsubsidized and your direct subsidized are going to have different rates from your graduate school direct loans, and then your Graduate Plus and the Parent Plus will be the same. But every year they price it in May, and so what happens is there's usually this mad rush of people to go find their financing for their next year's education between May and call it July of the year before you go to school. And that's really when you're going to be pricing that private versus the plus loans. We're looking for your federal funding. But the places of action is that time period when you're securing your financing. But if you are attending school, you should fill out FAFSA every year, federal financial aid, see if you get any aid from them. And you should be filling that out in October of each year prior to your education. Some of the aid, I'm told, is first come, first serve. So you just want to be first in line to fill that out. And FAFSA opens up October 1st of each year. We can go to the next one here. Here's the illustration of the pricing for the loans in the last couple of years. And you can see those plus loans upwards of 6.28% last year. If you look back prior to the economic troubles we've had in the last couple of years, you'll see loans in the 7.4, and even 8% if you look way back. The direct undergraduate student loans, those do not fluctuate as much, but they do move. So you'll look at it each year as to what the pricing is going to be. And then those graduate professional loans are the direct federal student loans for graduate school. All these names are kind of, you see them in different places. Everybody calls them different things, but those, like I said, it's a pretty fair pricing. 4.3% last year. This year it's a little bit high at 5.28. But it's rare that you see those over like 6.25%. So pretty good loans as far as the pricing goes. Let's move forward. Understanding your repayment options. And so when you're understanding your repayment options, it's very important to recognize what you're eligible for. And so I mentioned public service loan forgiveness before. The opportunity set for PSLF or public service loan forgiveness, the option on that, we can usually get people out of their student loans and get the loans forgiven at a total cost that's lower than the principal of the loans. So you don't even pay the full amount that you owe without interest. So it's very valuable if you're going to work for a nonprofit that files as a 501c3, or if you work for a government entity. So public service loan forgiveness is very valuable there. Now, the other thing is the only loans that are eligible for public service loan forgiveness are direct federal student loans, which is why Jenny was asking if she can convert her health education assistance loans into direct federal student loans. And you can do that as, again, it comes down to a lot of different provisions. But if you have federally issued student loans, so the biggest glut is these things called FEL loans, where the federal government gave those loans out, but then they sold them to Wall Street. So they're federally issued, not federally owned. And those were not eligible for a long time. We'll talk about the Biden waiver in a minute, but that changed things a little bit. So if you know you're going to a nonprofit setting, if you know you're going to work for a nonprofit, PSLF is something you have to explore. If you're not sure where you're going to go, then there are federal programs, depending on your affordability on repayment, that you might want to look into that can minimize your accruing interest. And that's an income-driven repayment program that has an interest rate subsidy that's built in. So if you're trying to maintain affordability and prevent those loans from growing, the revised pay-as-you-earn program is often a good structure to go into. We use it mainly for graduating med school students who are going into their residency. So they're not going to earn some money for a while, but they need to keep those loans from growing on them at a rapid pace. The third area is where you're coming out, you've got a job, you're working in the private industry, you can afford your student loans. Now we're looking at minimizing that cost. And that's when we're going to refinance those loans. We're going to get you the best interest rate and repayment term on the loans. So we're going to get out of those loans at the minimum cost, but also we're going to look at different repayment structures, so different terms. So you don't have to pay it down in 5 years. Sometimes, especially in the last 6 months, when people were getting 3% on a 20-year interest rate, it makes sense to take that 20-year and pay it down, when you have the opportunity over that time period. Let's go to the next page. Cool. So income-driven repayment. Anybody who graduated in the last couple of years where they haven't had a payment, or people who are using income-driven repayment, throughout before the CARES Act, again, you really need to make sure you check on studentaid.gov, see what repayment program you're currently on, see what that payment is, and make sure that it's affordable for you. So income-driven repayment programs can set a monthly payment for you that is very affordable. So what they do is they ignore the balance and the interest rate and the repayment term on your loans. The loans don't matter. And they look at what you made on your tax returns the prior year. And there's a discount for the poverty rate in your state. And then they take a percentage of the remaining income. And it's usually either 10 or 15%, depending on the year of your loan's issuance. They divide that by 12, and that's your monthly payment. For somebody who graduated school last year, right? You might be working for a job making $50,000 this year, and you probably started in August, September, right? And so your income last year was $25,000, maybe even less. If you use an income-driven repayment program, you can get 12 months where your required monthly payment might be $10, and sometimes it's even zero. And so these programs are great to keep you at an affordable place until you can get the earnings under your belt and start making income and start making your monthly payments. Now, complacency is really dangerous in these programs because remember I said they ignore the functioning aspects of your loan. The problem is that the loan keeps going. So even though the payments are calculated ignoring the growth of your loans and the interest on your loans, the interest keeps going. So there's this thing that can happen on these income-driven repayment programs called negative amortization. And what that means is the monthly payment that's coming in is not big enough to cover the growing interest on the loans. So what essentially happens is you're making these income-driven payments and thinking you're doing a good job, and here the loans are growing on you. And if you don't pay attention to this and address it properly, or if you're not heading down the path to the public service loan forgiveness, this is really dangerous because those loans can grow and get to a point where they're then insurmountable. So the income-driven repayment programs can be a great tool for affordability, but more often than not, they're also a really big danger if you try to stay on them for a long time. There are loan forgiveness opportunities, even if you don't work for qualified employers on income-driven repayment programs, but they're 20 and 25 years long. It's a long time. A lot can happen between now and then. And additionally, at the end of that forgiveness period, any dollars forgiven, as the tax laws are drawn up today, it's fully taxable. And so what that means is, if you get $100,000 forgiven, you might have to pay $40,000 of taxes, depending on your state, your locality, and where you live. But you got to be prepared if that's the direction you're going. But what tends to happen is people set out for that 20 or 25 year forgiveness, and they end up making a lot of money somewhere along the way, whether it's year 5 or year 10 or year 17. But once they start making all that money, they end up paying back the loans. But here they've just carried a really high interest rate the whole time. So they've lost money or opportunity cost by not refinancing instead of doing those income-driven, or instead of the income-driven program till forgiveness. We can analyze that. We have systems that can model out your income for 25 years and see where you're going to fall. But more often than not, and I'm talking 90+% of the time, that is not a great solution and not a great long-term solution. Let's go to the next one. Well, so these are the different income-driven repayment programs. Earlier I mentioned revised pay-as-you-earn. That's the one that has an income, interest rate subsidy for the first 3 years you're on the program. The government comes in and any unpaid interest each month is cut in half. So again, that can be a good program, but that interest can come back if you mess things up. So it's important to really dig into the details so you don't have that interest added back in by coming off of the program messing up. Now the positive, and I guess a negative with revised pay as you earn is they're going to look at the household income, no matter if you file your taxes separately or you file your taxes jointly. And so if you're young, you get married, you're making $50,000 a year, your spouse is making $50,000 a year, guess what? When you were paying on just your income, your monthly payment might have been $240 a month. Well, now you get married, that combined household income is $100,000. Your monthly payment's going to go up by approximately $470 a month. So, um, so you really have to be careful on revised pay as you earn because of that consideration. Income-based repayment and pay as you earn, those are programs that allow for you to file your taxes. It's called married filing separately. And married filing separately, what they would do is you have to file your taxes separately, which usually costs you a bit as far as annual tax savings. But it can save you a lot of money on an annualized basis and really on a monthly basis on that payment calculation. Again, the $50,000 of earnings for the spouse, it's really about 10% of that earnings divided by 12, and that's the monthly payment difference. But 10% of 50,000 is $5,000, and that's the difference there. Income contingent repayment is not a program that's often used because there's a really high calculation. It's a higher percentage calculation for your monthly payment. Parent Plus loans are only eligible for income contingent repayment. So that's something to consider if you're dealing with those Parent Plus loans. But let's move to the next one here, Ryan. And cool. So public service loan forgiveness. It was a program GradFin really dove into and formed probably one of the strongest expertise there is out there. But it's a law. It was signed into law in 2007, and the original law, I guess it kicked in 2008, and so people's loans started to get forgiven, or applications started to come in for forgiveness around 2018. So it's really pretty new, right? So we got 2018 to 2022, where people have actually been able to finalize and execute on their loans. The way the program works is you have to earn 120 qualifying payments. And I think about a qualifying payment as a point. You can only earn one per month, and you have to fulfill 3 obligations. 3 things have to be happening for you to earn a qualifying payment. And then there's an administrative side that you have to execute on to document and ensure and prove that you're executing on those 3 things. The 3 things are: number 1, you need eligible student loans. And an eligible student loan is a direct federal student loan. Number 2, I guess it's not in order, but the next thing you need to do is work full-time for a qualified entity. And a qualified entity is a nonprofit that files its taxes as 501c3, or it's a government entity. Now, you can't be contracted by that, so you can't be 1099. You have to actually work full-time for the qualified entity. The third thing that needs to happen is you need to fully participate in a qualified repayment program, and properly participate in a qualified repayment program. A qualified repayment program is an income-driven repayment program, or it's the standard 10-year repayment program. You have to pick and manage your way through those income-driven repayment programs appropriately. And we already talked about the troubles that can come in if you get married and you're on the wrong program, and all of a sudden your monthly payment goes up pretty enormously. So that's part of what we help people out with. But let's move forward here. Cool. The PSLF waiver. So I think I have another slide that's next, but basically what happened is in 2018, when all those applications for forgiveness came in, the turn down rate in 2018 was 99.9%. In 2019, it was approximately the same. In 2020, it started to go down slightly. I think it got as low as 96 or 97% as far as the turn down rate. So what was happening and what was going on? The biggest thing is people just weren't compliant with the law. So they might have been doing 2 or 3 of those things that I just talked to you about, those required things, but either they weren't documenting them properly, or they were violating one of them. A big one was people were on those income-driven repayment programs, and all of a sudden the calculation for their monthly payment got high, so they switched out of them, and then they applied for forgiveness, but it doesn't work that way. Another is they might have had Perkins or Fell loans. Again, the question on the healthcare loans, if they're not converted and properly handled, they didn't count for public service loan forgiveness. Now, in October of this year, President Biden signed a waiver which provided a lot of flexibility, and I mean a ton of flexibility around public service loan forgiveness. And the goal is to bring down that turn down rate. And so what he provided was a lot of flexibility around the types of loans. So now, even if you had Fell loans or Perkins loans, as long as we can prove that you are making payments on them and that you were working full-time for a qualified employer, we can get historic qualifying payments on those. So we can retroactively look back and go and get those. That was a huge opening. Another was there were all these intricacies around the payments that were coming in on the income-driven repayment programs. And some of these were calculations for monthly payment were different for one servicer versus another. And so when people went to apply, the payments that they were making weren't calculated properly. So none of their payments counted. President Biden provided flexibility around that as well. Now, this is only until October 31st of 2022. So you have to get your corrections, amendments, and your employment certifications all in prior to that date, or this waiver is supposed to expire. Some additional things, just some automated employment verifications for people who are federal government employees and active duty military. That wasn't happening at the time. And then the repayment programs. So even if you were on non-income driven repayment programs, as long as you are making or attempting to make, which it says, payments, those payments can count as qualified payments. So we have customers who are coming to us, a lot of teachers actually, which is really fun and rewarding, but coming to us when we're reviewing their student loans and 4 months later, getting them forgiven. It's really, really pretty cool. But the waiver provided a lot of flexibility there. Currently, I mean, there's really a lot of hat hanging, I guess, around that flexibility. It's close to $10 billion, I would estimate, of eligible loans to be forgiven now. Let's go to the next slide here. This is the slide I was talking about. Pretty much already covered these. Yeah, let's go to the next one. And quick, I guess advertisement on our GradFin PSLF membership program. I oftentimes equate it to like H&R Block for public service loan forgiveness. So it's an annual fee, and what we do is we make sure all your paperwork's filed properly. Because if it's not filed properly, it gets rejected. But we make sure you're on track for public service loan forgiveness. And then we make sure you're on the proper income-driven repayment program. And we'll calculate out, hey, like this is what it's going to cost you to file your taxes jointly. This is what, that it would save you in monthly payments. So you can go to your tax professional and say, all right, what's it going to cost to file jointly? What's it going to cost to file separately? And whether you're going to make money or lose money by staying on an income-driven repayment program. But to date, 100% of the people that we've taken through for forgiveness have achieved it. So we've proven it; it works. You just have to file and really make sure you stay compliant in order to earn forgiveness. And also it's not income dependent at all. We've had doctors get their loans forgiven who are making $500,000 a year. We've had teachers and run-of-the-mill people who aren't making much money at all, and we've been able to get their loans forgiven. As long as you earn those 120 qualifying payments, the program works. You get tax-free forgiveness. Go to the next one. Some of the success stories. $337,000. I think we eclipsed $5 million of loans forgiven. But the cool one I like is these retroactive payments. And with the waiver, it's been a little bit easier. But even before the waiver, we went back and we were able to get one borrower 108 qualifying payments. And it's not easy if you're going back and getting retroactive payments, meaning you've been participating properly, but now you have to go and look backwards for, sometimes 8, 9, with the waiver, 10 years. It takes the government a while to review that. Oftentimes, even with the waiver, they don't accept all the payments. We've done this so many times that we know what mistakes they make, and we'll go back and we can appeal that for our clients and go back and through that appeal, we can usually fight and get you those qualifying payments. It does take some time. It's government agencies that you're dealing with, but it can save you a lot of money if we can go back and get those. So 250 plus appeals that we've won. Cool. Let's go next. Now, if you're not going public service loan forgiveness, again, 90% of the time you're repaying your student loans. And if you have private student loans, it's a no-brainer. The interest rate that you borrowed for 4 years or for graduate school with private student loans, they assume you haven't finished your school, and their bet is they don't know whether you're going to finish school. So the interest rate is set high. The day you graduate, you get a job, and you're not, living on the couch. Your risk of repayment is lower, so you can get a lower interest rate on your loan. So if you have private student loans, you want to look to refinance those loans as soon as possible. Or if you know that PSLF is not your opportunity and you're going to repay your loans, it makes sense to explore refinancing options for your loans. So it's important. We always like to educate people on how do they review you, what goes into the pricing. And what we found is every bank is different, and they all have different pricing metrics. Some will just look at your credit score, and as long as your income qualifies, your credit score is going to give you an interest rate. Others look at affordability metrics. So how much do you make versus how much do you have to pay each month? And that's a big determining factor. Others look at education. If you're in medicine, if you're an RN, you get a 30 basis point discount at a lot of lenders. Even some will look at savings. Are you able to put money away each month, or are you just struggling to go month by month here? But essentially, you've got income, you have the debt to income ratio, education, and your credit score. You can control some of these things, and you have a lot of control on them. Other things you don't, right? Your income, you don't really have a ton of control. You get the best job you can, right? Your debt to income ratio, though, you can control. Don't put a lot of money on credit cards, right? Open a credit card, have that availability, but don't carry a balance. Don't go out and buy a car and get yourself into a big lease or a monthly payment. Fix your student loans first. Don't go and sign a big rental agreement and have a huge rental expense each month until you fix your student loans. So you have a ton of control there. Also, your credit score, you have a ton of control. Go out and get Credit Karma, monitor it, follow those little steps it tells you to get that credit score higher. Biggest problem I see with young borrowers is they go out, they get a credit card, somebody tells them they're supposed to use it, or hey, it's a good idea to carry a balance on there because that's how you really establish credit. Don't carry the balance, pay it off each month. If you carry a balance on your credit card and you're young, right? So you might have a max balance of, call it $2,000. And if you're carrying $1,000 balance on there, what they say is you're 50% drawn, or you are using 50% of your revolving credit. So your revolving credit utilization is too high. I've heard some people say 30% or more. I've heard other people say 20% or more. But basically, when they consider your revolving credit utilization too high, that credit score is going to go down. And they will take that credit score down. It's easy to fix. You pay off your credit card debt, goes right back up. But that can have a 50-point swing sometimes even more, for somebody who's in their early, mid-20s or even late 20s. So let's go to the next one here. I'm doing on time. Current interest rates. Listen, interest rates are higher than their lows. The lows were probably about a month ago, but they're still really low compared to years ago. If refinancing is the right opportunity for you, you need to explore that today. It's really behooves you, because I mean, I have borrowers who applied 2 months ago and they said, no, I'm going to hold off because of the waiver. And then they applied today, and it was a 1% higher interest rate. So we know that the interest rates are going to move up as far as the Fed goes throughout the year to battle inflation. So it really makes sense to explore refinancing today. The way GradFin works, it's not just one lender we go to. We have a platform of 20 different lenders. So we're going to go out, we're going to find you the best available rate, and also we'll coach you on, who's going to give you the most probability or the highest probability for acceptance. So do you need a cosigner? What kind of cosigner do you need? Are you making enough money? Can you get that earnings bumped up? We'll tell you where you are and why you can or can't get a refinance today, so you know how to fix it. It's very important to have financial literacy and understand what your options are. I think that's probably pretty close to wrapping it up. Cool. With that, are we going to try to open up to questions here?
Yeah, absolutely. For anyone who has questions, we can throw them either in the chat, or there is a Q&A tab as well for any participants that have any questions at the moment.
And Jenny, if you want to, 844 GradFin is an 800 number. It should connect you with somebody, or you can go on our website and book an appointment. But what we're going to ask you to pull is your NSLDS file from studentaid.gov. And with that, we should be able to determine if that loan can be consolidated and converted into a direct federal student loan for you. But it's something I just can't do on the call, because I have seen some that got through and others that didn't.
Awesome. Thank you, Kyle. Yeah, Kyle, your information and GradFin's information there is on the screen. We'll also have information posted on our website. If anybody in this session is thinking this might be good for somebody else, we'll also have the recording posted for them to see. But Kyle, thank you so much for joining us today. And thank you to all our participants for joining as well. I hope this was a great session for you. I know I learned quite a bit just from hearing this over the last hour. But Kyle, once again, thank you for coming and joining us today.
Thank you for having me, Ryan. And thank you, everybody, for attending. Hope everybody has a great day.
Yeah, thank you, everyone. Have a great evening.